The stock market dropped and traders were confused. Hey, wait a minute, stocks can drop? But slowly throughout the day they began to climb. Although they remained in the negative, thankfully complacency is definitely back on, so we can keep the party going. Nothing worse than facts to spoil a good party, that's for sure. Keep the music blasting to drown out all of that information stuff, then fill your head with these three letters, B-U-Y. You came here for the truth, so let me unveil that for you. Today we are going to look at what has been happening in the markets. I'm going to get into some detail there. We're going to look at the economic factors as well, talking about shipping. We're going to talk about what Goldman Sachs had to say. I'm going to talk about the Federal Reserve as well as always, and so much more. Let's begin by taking a look at the markets. Here you can see the Dow Jones at the end of the day, it was down 128 points. This was an interesting moment though, because the market fell. I think the Dow was down something like, let's say 300 points at one point. And you could see that the traders were asking why? Why did this happen? Normally throughout the day, you get this linear flow of data as it's coming in, and there might be an event that occurs. That event could be good earnings, for instance. It could be some sort of shock. It could be anything, but ultimately the stocks will rise or fall based on that information. In this case here, it seemed like it was a normal day. Bad information everywhere and the market would ignore it. But this time around, we saw things drop. That freaked them out because they didn't exactly know what was the cause of it. Now, as you could see throughout the day, it started to climb again. There's no problem at all. Let's just pick up the pieces, buy the dip, you know the drill. I'm just interested to see if we do have these type of events that take place, not necessarily a flash crash, but just not understanding why the market is moving up or down. Take a look at the Federal Reserve's balance sheet. I give you the weekly update, and here we are again. You can see that it actually came down a little bit this instance for this week, and we are sitting at, almost $4.2 trillion. It has been moving within this range now for several weeks at this point, and it has not continued that climb. It all depends on the maturity of the so-called assets that they're holding and everything else. They have been actively trying to expand their balance sheet. It must be related to what's going on. I haven't followed the whole rabbit hole and trying to check every maturity of all of their different assets and everything. I haven't gone that far. This is likely what it is because they are printing money every single month and are trying to expand the balance sheet. They know about that, but they say it's for the reserves. So again, just an update. I'll move on. Fed staff float plan to end term repo after April, and can you believe it or not, at the bottom here, it says this received a warm reception from policymakers. Explain how the Fed could gradually reduce interventions in the market for repurchase agreements or repo and slow its balance sheet expansion. But that's going to have to wait until April because we know that as of this moment, the repos are going on consistently. Whether it's a term repos or the overnights, they are actively engaging in this manipulation. That's what I call it, absolute manipulation. There's no way that they can stop anytime soon. I would really, really love them to just pull the plug. All of their programs, pull the plug, see what happens. That would be a good test. If we have a strong economy, we got a strong market, why not? Why not get rid of all that support and you can have it naturally go forever and ever. But you and I both know that isn't going to happen because this market is a joke. Goldman Sachs. Now, if I scroll up to the top here, we're going to get the chart. Look at this. Goldman sees high risk of stock market correction on complacency. That's right. We are looking at a market that simply doesn't care about what's going on. If you look at this objectively, you know exactly what this is. It's crazy to see how far people are willing to go, how they will push themselves to the absolute edge. I see comments all the time. I am buying the S&P leveraged ETF, 3x leverage. These people hopefully do not put a lot into there. Look, you have to invest what you're willing to lose. I don't think a lot of people are willing to lose this. They just think the S&P, the stock market, whatever market you're putting your money into never goes down. It might go down for a day, might go down for an hour, but it never goes down over the long term. And they go to their bank manager and they see that chart that every single financial planner has this big chart on their desk to make sure that you see it. They look at the Dow Jones 100 years ago, look at it today, and wow, if I would have put $1 in there back in that time, and I would have been rich today. And that's just foolhardy. It's really uncomfortable for me to hear this type of information, and I feel nothing but pity. Investors might be underestimating the negative impact of what's happening here in China on corporate earnings that poses a threat to the stock market rally, according to Goldman Sachs. Equity markets are looking increasingly exposed to near-term downward surprises to earnings growth, while a sustained bear market does not look likely. A near-term correction is looking much more probable. So of course, we'll see what happens. Supposedly, Europe has a much bigger exposure to what's happening in China. I want to see, because regardless, I find that the markets overreact. They overreact on the top side like we're seeing right now, and then eventually they overreact to the downside, because this is the market. The euphoria works on the way up as well as the way down. Now, they're looking at the Cass Freight Index. This is the worst year-over-year growth in shipment volumes since late 2009. You could see this chart here, how terrible it looks. I'll zoom in to give you a better look at this. Maybe you could see it a bit better. And, I just want to stress the fact that this is an absolute key indicator to be paying attention to. You could look at the price of oil, and, you could look at PE ratios and things. I don't necessarily think that any one indicator is better than all the rest, but we need to look at some of them. There are a handful of them that are truly very important. Anyway, taking a look at this, you can see that this has been going on for quite some time. If you can't read this right now, at the bottom, that's January 2018. Basically, beginning of 2018 up until the present, this has been sliding down further and further and further. We've seen this happen before, of course, 2008 leading into 2009. This had been a serious contraction, and we're looking at a similar pattern today. Whether or not it ends up being the same situation, I don't know, but that's definitely showing us in this chart. Out of CNBC, America's manufacturing recession looks like it could be over. Well, they hadn't even admitted that it was going on in the first place, but hey, don't worry, it's over now. Nothing to worry about. They talk about the reasons why, and it's an absolute joke. If you want to laugh, or maybe you want to get aggravated, you can read this article. I just wanted to show you it because there is complete and utter propaganda that we have to just deal with. Oh, I can't even find the words. The U.S. stock market capitalization has continued to rise. That's the chart on the left-hand side. We are comparing the U.S. equity market cap over the GDP. We've shown these numbers so many times. I know you've seen them on your own as well. On the right-hand side, the same is happening globally. World equity market cap and world nominal GDP. It isn't quite at the same level as, when we look at this from 2000, but it's basically getting there. In both cases here, we are seeing on a global level, there is this mass hypnosis that nothing can go wrong because central banks are there to backstop any losses. Speaking of central banks, Vice Chair Clarita out of the Fed throws cold water on traders pricing in a rate cut. That's right, but throws the caveat in there that the situation that's going on in China, that is one definite possibility that if it starts to impact things around the world, and we could see that in the data, that's a rate cut coming. That's right, they did multiple rate cuts in 2019. Instead, they were supposed to actually increase rates. They went for the rate cuts. They started their QE program, and look at what they're talking about today. Any excuse to cut interest rates, even though they've got such little room to work with. This is going to be amazing. It's going to be fireworks on display. This website here, I believe it's Dana Lyons, and this is just a refresher of what options are, because I've brought them up before, and I know that not all the subscribers know what this is talking about. I'm going to make some references to that in a moment, but I wanted you to know this information first. Options traders use calls to bet on market gains and use puts as protection against declines. When a disproportionate amount of volume is going into calls relative to puts, it generally means traders are very bullish and potentially too complacent about risk. We are seeing indications of that from multiple exchanges. So it's not just in one place, it's not an anomaly. We're seeing that across the board. It might be a little difficult to see for yourself, but essentially right here, we are witnessing extremes. And that's what it comes down to. You don't have to know all the details. You don't have to know this in and out, but just understand that we are seeing this going further than it has ever gone before. Breadth. Percentage of stocks outperforming the index, and we see it going to a level that is not very healthy. We're watching this. A similar repeated pattern occurred during, the lead up to the financial crisis, and we're actually in a much worse situation today in this case. But all I know is that there is more and more concentration of these stocks. ETFs are a massive problem if you look at this on a deeper level and you're willing to admit it. ETFs are a problem, though many people have been able to simply buy into these indexes and watch their portfolio grow. I understand why people do it, but just understand the consequences of it. We also see what's going on with the top tech stocks. Tech stocks have been huge buys, obviously, and we are witnessing this going into repeated patterns that we saw during the year 2000. Not necessarily that, it's just mass speculation that is completely uncalled for, but the fact that people today believe nothing could ever go wrong. S&P 500 stock concentration, you could see it even exceeding what we saw during the financial crisis. I'm not going to get into all the details of these 4 charts here, but Morgan Stanley provides them. You could pause the video. You can look into the link in the description, essentially just showing that traders have an extremely complacent attitude, risk on, and everything else I've been talking about. Virgin Galactic overdue for a correction, Morgan Stanley says, after 310% rally in 3 months. Then further along, Morgan Stanley said that the stock deserves a bit of a breather here. A modest correction is overdue and frankly healthy in our opinion. But the traders don't want to see that. They don't want to look at something and think to themselves, all right, well, what am I going to do exactly? I want my portfolio to grow every single day. So maybe I'll just use leverage, and that way that will get me out of this little rut when the stock goes down for an afternoon. Well, even gold has been surging. In this case here, we're seeing it at a 7-year high as investors seek safety trade. Of course, we're not talking about real gold, we're talking about paper gold, but regardless, when we see gold go up, you know that investors are looking for a safe place to keep their money. This is funny because these same people or investors, these big institutions, they're looking for a backup plan. They're looking for a hedge, even though stocks are continuing to rise, even though that mentality is there that, oh, don't worry, the Federal Reserve is going to back it up. They're still buying gold to a point in which it has gone really, really high. IMF says Argentine debt unsustainable, calls on bondholders to, quote, help resolve the crisis. We have witnessed the biggest bailout in IMF history. That money, your tax dollars in part, went to bail out Argentina, and now it's gone like a puff of smoke. Your money, your tax dollars, gone to another country to bail them out on terms that are essentially impossible for them to ever pay back because the whole thing is a sham from day one. I want you to be upset when you see a bailout taking place, even if it's in a different country. If you only took the time to see what's really going on, you would be outraged too. But I see so much complacency today, and truly, it is unfortunate. If you found this video informative, hit that thumbs up button. Don't go anywhere until you hit that button. Thank you very much. If you want to learn about what e-commerce is all about, you got to find a course out there, but so many charge you $1,000, $2,000 and beyond. I actually pay money to have this service operated, and I give it to you for free. So please take advantage. It's at the AmazonGPS.com. If you want to know about the financial industry, everything, top to bottom, it's all here in these 2 books. I wrote them to make it so easy for people, whether you're in the financial industry or you're just the average person. You want to know and you want to be able to ask the right questions. Check them out, link in description. If you prefer the audiobook, themoneygps.com. Wait a second, hang on, don't go anywhere. This video is jam-packed with data, and for some reason, only about 15,000, 20,000 people have seen it. That's not good because they're going to miss out on all of the good stuff. Check it out, click on it, I'll see you there.